Welcome back. There are a few odds and ends we haven't discussed yet. They can be relevant regardless of whether our future looks great or dim. Let's go briefly over them and then summarize all the different forces under imperfect capital markets that we have discussed in the last two chapters. Now, first, I want to discuss what's called a financing pyramid. Many companies have more funding by senior claims, that is debt, than more junior claims, that is equity. This is especially strong after poor performance, not so much after great performance, because what usually happens is the equity increases in value, the debt doesn't increase very much. You've had great performance, so all of a sudden, it's no longer a finance pyramid where there's a little bit of equity at the top and a lot of debt at the bottom, but there's not as much debt relative to a lot of equity there. Now, this is very different than the pecking order that we talked about in the previous videos. The pecking order said that companies prefer to issue debt over equity because if they knew that good times were ahead, they would not want to issue equity. They would want to keep the equity to themselves and just borrow money. Now, in a static perspective, that would actually then result in the case you have a lot of debt and very little equity. But firms are not static because what happens typically is after good performance, the equity can increase so much that it's no longer a financing pyramid. So a pecking order can lead to a financing pyramid, but it need not. So financing pyramid conveys firms have more senior debt than junior equity, and it should be more the case if everything was static and debt was cheaper than equity. It's particularly the case also for financial services companies. They have a lot of debt at the bottom. Banks, investment banks are very much financed with a lot of debt. As much as 90, 95, 96% could be financed with debt, and only 3 to 5% might be financed with equity. But again, this is a very static view. It tends to be more the case if firms have done poorly. If a firm has really done poorly, has become really distressed, what happens is whatever equity it had is going to shrink, and therefore this firm has even more of a financing pyramid. Tech firms and pharmaceutical firms have done incredibly well over the last 20 years. Therefore, you will see many tech and pharmaceutical firms that have nothing like a financing pyramid, that have very little debt and a lot of equity. Now, another thing that we haven't talked about much are liquidity and transaction costs. This could be direct costs of issuing or maintaining debt or equity. It could be liquidity related. We know, for example, that shares in publicly traded markets are very easy to buy and sell, whereas corporate debt is much harder to buy and sell. It could also depend on the issuing costs. It turns out when you want to issue debt, the costs of that are fairly low compared to the costs of issuing equity. It could also be that the recombining costs have an influence here. Remember how M&M worked. Modigliani Miller worked by saying, well, if the capital structure isn't ideal, why don't we just buy back all the securities, then issue the optimal set of securities, and thereby make money? But there are also dynamic aspects to this. So for example, if I get close to bankruptcy, that probably means that I have too much debt and not enough equity. But now the problem is that I may not be able to muster enough funds in order to buy back the debt and issue equity. And all the benefits of doing so are going to accrue to the debt holders that now get more payment than they otherwise would. So there are a lot of dynamic considerations here that can mess everything up. Another thing that we haven't talked about much here is diffuse versus concentrated holdings. So if you have diffuse shareholders, millions of shareholders, you spread the risk very well. But the problem is nobody may mind the store, so nobody may look over what your executives are actually doing. A concentrated owner, like Elon Musk for Tesla, has a lot more risk to bear in Tesla and therefore may pay a lot more attention to it. But then again, Elon Musk also is incredibly exposed to how Tesla is going to do. So These are classic trade-offs, and the solutions inside the United States and outside the United States are very different. Also, the way that boards are structured, how influential they are, is very different. In the US, realistically, most boards are really not in control anymore of their executives, and their executives are somewhat out of control. They've become very self-serving. In other countries, the problem is not so much that the executives of the companies want to enrich themselves, is that there is somebody else who owns most of the company, probably inherited it over 5 generations, and what they really want to do is control the company and suck the money out of the company to them, rather than to all shareholders equally. So different problems, different solutions. Here's another interesting question. As a capital structure consultant, working for an investment bank, what is your job? Is it your job to convince the firm to have the best capital structure it can be? Or is it your job to convince the firm to change its capital structure? What if you determine that the firm should have more debt and less equity? So, for example, one of the explanations we looked at is that managers like to waste money, so debt will put more discipline on them. So, how will this go if you go to management and you ask them, well, I think you should have more debt because this will prevent you from buying a corporate plane and therefore help the shareholders? How well do you think this will go? Okay, here's a summary of the various effects we talked about. If you have unmitigated agency conflicts, it tends to be that the managers who are now in charge prefer equity because that gives them the flexibility they want. Financial distress costs. If you have high financial distress costs, you probably want to have more equity in order to reduce the probability of financial distress. For personal income taxes, again, equity is probably better because equity is subject to lower tax, in particular if it's capital gains tax. If there's worry about debt expropriation that the firm will want to shift risk, again, it's better to have more equity. That way you don't have the conflict of interest between debt and equity. Now, when it comes to corporate income taxes, on the other hand, it's better to have debt because the interest payments on debt are tax deductible. Similarly, if you have too much cash flow, that is, if you have a mitigated agency conflict where you want to prevent the managers from wasting money on corporate planes, debt is better. And then you have all sorts of behavioral finance and transaction costs arguments. Adjustments, as I already described, this can be very difficult to make, especially in financial distress. Your reputation can help you, but generally these are not easy things to do. So, how does the optimal capital structure look like? So here I have graphed the weighted average cost of capital as a function of different debt ratios. So the x-axis is the debt ratio that you choose. This here is the rate of return in percent that your weighted average cost of capital should be. And this turns out to be the lowest. But what you can see here is it's incredibly flat before and after. So unless you have a firm that sits somewhere here on the right side, it doesn't really matter whether you have a debt ratio of 30%, 40%, or 50%. It's really almost all alike. The world is almost as if it was Modigliani Miller, almost as if it was a perfect capital market. The capital structure really doesn't matter much. Capital structure matters when you have financially distressed firms or when you have financial trading firms, both of which come with a situation of 90% or higher debt ratios. So, capital structure is only of first order importance for firms with a lot of debt. It's of secondary importance in most normal companies. This is normal companies that are publicly traded. This is not startup companies. Startup companies definitely live in more incomplete capital markets, and for them, it can be of primary importance that they don't run out of money and that the debt isn't going to eat them alive. So I made up the function here. There are no well-estimated empirical relationships here. There are transaction costs, but the general insight is probably fairly true. For large publicly traded companies, optimizing capital structure is a waste of time. Whether you make it 30%, 40%, 50%, the value is going to be about the same. Finally, there is a figure in the book that actually goes through all these different factors and tries to put some dollar numbers on this. And I think it'll help you think about what is where. So please take a look at that figure. So that's it for this video for chapter 19 and for the subject of capital structure. In the next chapter, we'll talk about the flip side of the coin, payout policy. See you soon. Bis bald.